Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Google stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Google is a search engine, online advertising, cloud computing, and e-commerce company. It has been referred to as the most powerful company in the world and one of the world's most valuable brands due to its market dominance, data collection, and technological advantages in the area of artificial intelligence. It is considered one of the big 5 American information technology companies alongside Amazon, Apple, Meta, and Microsoft. Google owns YouTube, Waze, Fitbit, and many more brands. The company is headquartered in Mountain View, California, and was founded in 1998. The ticker trades on the Nasdaq, Deutsche Börse, Mexican Bolsa, London Stock Exchange, Xetra, Vienna, EuroTLX, Swiss, Sao Paulo, Buenos Aires, Bulgaria, Colombia, Lima, Borsa, Italiana, and Santiago Stock Exchange. Let's get started with the model. This is a large cap company, 1.4 trillion market cap. They're trading at $22.76 a share, and they have 631 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Their free cash flow more than doubled from 2019, 31 billion to 69 billion. Net income is the profit or loss on the income statement. It's revenue minus expenses. And that also more than doubled from 34 billion to 75 billion. Revenue is a sales for the company, and that grows each year from 162 billion to 270 billion. This is the company's first quarter income statement compared to the first quarter of last year. Their quarterly income grew from 55 billion to 68 billion. They received 40 billion of revenue from Google AdWords, 7 billion from YouTube ads, and 8.2 billion from other Google businesses. Google advertising is 55 billion of their revenue. Other is 7 billion. They generated 6 billion from Google Cloud. Total revenue is up 13 billion quarter over quarter. They received 22 billion of revenue from Europe, Middle East, and Africa, 13 billion from Asia Pacific, 4 billion from North America excluding the US, and 32 billion of revenue from the US. Their cost of revenue is 30 billion, R&D 9 billion, marketing 6 billion, general and administrative 3.4 billion. So total expenses are 48 billion, operating income of 20 billion, up from 16 billion, but they had negative other income and expenses. So their net income is lower than the first quarter of 2021. Their EPS is also lower from 26.63 to 24.90. But they did decrease their shares outstanding from 673 million to 660 million. This is their operating section on their statement of cash flows. They generated 25 billion of cash flow in the first quarter, so their cash flow is 9 billion higher than their net income. The reason it's higher is because we have to add back depreciation and amortization and also stock-based compensation. I like to track a company's revenue, that's the blue line, and operating cash flow, that's the orange line. And both numbers pretty much only go up, and they went up a lot in 2021. This is their investing and financing section on their statement of cash flows. In their investing section, they spent 10 billion of property, plant, and equipment. They have lots of cash on their balance sheet, so they bought 30 billion of marketable securities. In their financing section, they bought back 13 billion of stock. They added 16.4 billion of debt, but paid down 16.4 billion of debt. This is the equity section on their 331 balance sheet. They have 251 billion of equity. They raised 62 billion from selling their business, and they profited 191 billion from running their business. Let's look at the capital structure. 254 billion of equity, 15 billion of debt. They're 94% equity, 6% debt. And they could pay off all the debt with the cash on the balance sheet and still have 119 billion of cash left over. This blue line is their equity balance since 2015. The green line is their cash balance. The red line is their debt balance. Relative to their cash balance and equity balance, they pretty much have no debt. They have a really solid capital structure. I gave them the middle whack on Finbox, and that's the discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated the terminal value, which is all cash flows past year 4, that's $2 trillion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $1.8 trillion. We divide that by 631 million shares. And we get a calculated stock price of 2,800. They're trading at 2,300, so they're trading at a 19% discount. It's a buy according to the model. Their revenue projection for 2024 is $399 billion. And then for 2023, it's $349 billion. And for 2022, it's $302 billion. And to get their 2025 revenue, I grew it at a similar pace. So that's how I got their future revenue estimates. They convert 24% of their revenue into free cash flow, so I multiplied their future revenue estimates by 24%. That's how I got their future free cash flows. The website Simply Wall Street values the company at 5,200. They're saying it's 54% undervalued. 11 analysts priced this stock, and the average price target is 3,400. The lowest 3,150, the highest 3,900. This is where the stock has been trading the last 2 years. From May 2020 until the beginning of 2022, the stock only went up. Then the next 3 or 4 months, it went down. After they reported good fourth quarter earnings and the plan to do another stock split, the stock went up a lot, but it's down a good 30% since that point. In the past 2 years, the S&P 500 is up 47%, while this stock is up 78%. Recently, they reported their first quarter results, and they did beat their revenue, but missed on their earnings. So the stock has come down a little bit since they reported. But they did beat their earnings and revenue targets the 3 quarters before that. They have a beta of 1.06, so the stock moves with the market. It's flat the past 52 weeks, same as the S&P 500. The 52-week low is 2,200, the high is 3,000. And the stock is trading below its 50-day and 200-day moving average. 1.5 million shares are traded each day on this stock. 66% of the shares are held by institutions, and 1/5 of 1% of the shares are shorted. They plan to do a 20-for-1 stock split in July. They've only done 2 stock splits in the past, a 2-for-1 in 2014 and a 1-for-1 in 2015. Every year they increase their employee count. They're up to 157,000. 67% of the shares are held by institutions, 20% by the general public, and 13% by insiders. The salary of the CEO is $2 million, and their compensation package is $7.5 million. If you put $10,000 into this company when they started trading, you'd be at $43,000 today. That's a 20% annual return. The biggest shareholder is Vanguard at 6.7%. The founder of the company, Larry Page, owns 6%. Then BlackRock. The other founder of the company, Sergey Brin, 5.6%, and State Street. Let's look at their financial ratios. Their PE is looking good these days, 19.3. That's stock price over earnings per share. Price to sales of 5.3. Price to book of 5.7. And price to free cash flow of 21. Let's look at their non-current assets. They have $30 billion of non-marketable securities. 1.3 billion of deferred income taxes. This should help reduce their taxes in the future. 98 billion of property and equipment. The value of the assets they lease is $13 billion. 1.4 billion of intangibles. 23 billion of goodwill. Goodwill is the premium you pay when you acquire another company. And 5.4 billion of other. Let's look at their non-current liabilities. 15 billion of debt. 535 million of deferred revenue. Deferred revenue is when a customer prepays for a product or service the company will deliver in the future. They owe the government 9.2 billion of income taxes, 5.3 billion of deferred income taxes. This should increase their tax bill in the future. They owe 11.4 billion on their operating leases and 2.2 billion of other. Their return on invested capital is 12%. They can easily cover the interest payments with their operating income. They have a high ROE of 29%. They can cover their current liabilities with their current assets almost 3 times. Let's look at their current assets. They have 140 billion of cash or cash equivalents. They may have more cash on their balance sheet than any other company. It's possible Microsoft or Berkshire Hathaway has more. Their customers owe them $39 billion. The government owes them $1 billion in income taxes. They have $1.2 billion of inventory and $7 billion of other. Let's look at their current liabilities. They owe their vendors $6 billion. They owe their employees $14 billion. Accrued expenses of $31 billion. These are expenses the company has incurred, but it has not paid it yet. They have $9 billion of accrued revenue. This is when Google has provided the product or service, but has not received the cash yet. Deferred revenue is the opposite. They have received the cash, but have not yet provided the product or service. And they owe the government $800 million of income taxes. They generated $70 billion of free cash flow in the trailing 12 months. They have $116 billion of working capital, so the company is really well funded. The best way to look at ratios to compare them to companies in the same industry. There are 72 companies in the same industry as Google, and Google is better than average in every category except price to book and price to sales. They have a much better price to free cash flow and PE than the average company in their industry. They're the largest company by far. Their 3-year revenue growth rate is similar to average, and they have a really high ROA and ROE. So to summarize, I have them trading at a 19% discount, but I can't imagine the stock not going up more in the future. It's just such a big company, and it's so important to the entire world. They generate an absurd amount of revenue and free cash flow. I rank their free cash flow 9 out of 10, their revenue 10 out of 10, and their ratios 8 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.